Hi, India has $608 billion of Forex reserves, of foreign exchange reserves. Or to be specific, it is with the Reserve Bank of India. To give you a sense of how much that $608 billion is, it's the fifth largest in the world. And just, it's a coincidence that we are talking about Forex reserves in this month of June, when 30 years back in 1991, June, July, India had forex reserves of $1 billion, and that was enough for imports or paying for imports of 3 weeks. Today, we have $608 billion. That is enough for us to pay for imports of 15 months. Only four other countries have more forex reserves. That is Switzerland, Japan, Russia, and China. So we have come a very, very long way. But there is an issue with having so much forex reserves also. That is what Professor Ila Patnaik will discuss today. What is the downside of having $608 billion of forex and the RBI, to quote her, hoarding more or trying to hoard more? I'm YP Rajesh, managing editor at ThePrint, and welcome to another new episode of Ilanomics. Hi, Ila. So, this was very interesting for me when I was reading up that we had just $1 billion in 1991, in the summer of 1991, and that was enough to pay for imports of 3 weeks. That was a balance of payments crisis that led to the balance of payments crisis. Do you want to talk about that, about where we were at that point of time?
Yeah, so in the 80s, we had liberalized a bit in terms of imports, while we had not been able to increase our exports. And India had been borrowing, short-term debt, and they reached a point where we were unable to roll our debt over. So that's really basically trade credit. That trade credit is the credit we used to get for our imports, and we were, seen as a country that was going to default on its debt. We had shipped off, a plane load of gold. We borrowed. We went to the IMF and accepted conditionalities such as import liberalization and industrial liberalization, because we got rid of the licensing policy both in imports and in industry. That came along with the loan that we got, and at that point, that's the point when we had 3 weeks worth of import cover, and had run out of our dollar reserves pretty much. And then when once we got the loan, as well as we took steps in 91, 92, initial steps were really a freeze on imports in many ways. Now, this has been caused by many decades of inward looking policies, because while we were growing, even at a very slow pace, but we were importing oil, and oil price shocks, 71, then 79, and then again 91, and the Kuwait war had actually led our balance of payments to deteriorate, because while we continued to import oil and oil prices went up, those decades of 70s and 80s, our exports did not grow. We were not competitive. We were not competitive in global markets. And that was really, that mismatch was what led us to where we got to in 91.
And the forex reserves have grown. I mean, as you write in your column, which was published on the print.in this morning, the link will be in the description of this video. You say that April 2020, that's about 14 months back, it was $100 billion less. It was around $500 billion. What is the reason for this, growth of $100 billion in about 12 to 14 months, 13 months?
Yeah, so, let me just spend half a minute going back to the 90s, and then I'll come to the situation now. What we did was not only import liberalization, but we also liberalized the capital account to get inflow of capital. one of the reasons to do that was because as an emerging economy, as then we were not even emerging actually, at then we were a poor country, we needed to invest more than we saved. So as a country, if you want to invest more than you save as a country, then you need to borrow from abroad. Okay, so because we needed to borrow from abroad, borrow in the sense of resources, so it's not necessarily debt, but it's foreign capital inflows, which could be FDI, FII, as well as debt. So we opened up to foreign capital flows because we needed to, spend more than we were producing effectively. And what we saw right all the way up till the 2000s, so from 91 till about 2002-3 was a slow build-up of capital. And in the early 2000s, we reached about 42 billion. And that's when there was a lot of debate on whether the reserves were adequate or not. So reserve adequacy was, a term which people define differently. Somebody would say, is it enough to have at least 12 months of import cover? There used to be these rules called the Greenspan Guidotti rule, that how many months of import cover, and with that we should have at least 12 months of import cover. There were other measures of reserve adequacy, which would be, can we pay off all our short-term debt? So in case debt doesn't get rolled over, is the country able to pay off short-term debt or not? So, that story continued till about the early 2000s, when it was felt that yes, India has adequate reserves by almost all these measures. Any way you want to measure it, India had adequate reserves. Now the question comes: why does the RBI continue to accumulate reserves after that? And that is also about the last 12 months, where we've seen an addition of about $100 billion to reserves. Now, the right from 91, actually from 93, 94, when we opened up to FII investment, the RBI was also trying to manage the exchange rate. And because it was very important for India to export, and we did not want our exports to become uncompetitive, so RBI tried to prevent the appreciation that was happening when foreign capital came in. So when foreign capital comes in, a dollar comes in, the demand for the rupee goes up, and the rupee becomes more expensive, or it becomes stronger and it appreciates. And that makes our exports uncompetitive. So to try to prevent appreciation of the exchange rate, RBI kept buying. And so the journey for the last 2 decades has been mainly a journey of trying to prevent appreciation. Now, there have been a couple of episodes when there has been a sharp pressure on the rupee to depreciate. But in those episodes of depreciation, actually RBI hasn't much used its reserves, and there's a reason for that. If we can go into it, but if you really start using those reserves, then you encourage a speculative attack. But anyway, the RBI then just has, it's been more of a one-way thing, where it has over these years built more and more and more reserves. And as our GDP grows, the ratio, the current account deficit of about 2 or 3% is also what you get in as capital inflows, because you're basically borrowing those resources from abroad. And to prevent an appreciation, RBI has been hoarding reserves, buying up dollars, and thus hoarding reserves. I don't know if that answers.
Ila, I thought I was facing that issue, but some of our viewers are also complaining that your voice is very low. Maybe you need to move a little closer to the microphone, yeah, maybe that should be better. Thank you. Thanks. I think Shivam Pandey was one of the viewers who told us about it. Thank you, Shivam. Let's see if this works better. No, Ila, I think you need to speak a little louder.
I think, let me take off the mic. Maybe that's not working properly. Now, is this better?
Yes, this is better. This is better. So, Ila, This whole RBI intervention you have talked about in your column today has also invited allegations of currency manipulation. Why does it get into trouble with something like currency manipulation? I thought only China did currency manipulation.
Yeah, so if a country tries to prevent appreciation, okay, that means it is basically pushing to keep its currency weak. Uh, it it's a beggar thy neighbor policy in the sense that if other countries allow their currencies to appreciate, so emerging markets get capital flows, and let's say there are five emerging markets and most of them allow their currency to appreciate while one country doesn't, then that country becomes relatively better off compared to the others. And the typical term used for this is beggar thy neighbor. So you're basically becoming better off at the expense of your neighbors, and so that's not looked upon very kindly. You know, when you said that China does it, China is known to be a currency manipulator in that sense that it has prevented appreciation of its currency for many years, for decades, and it ended up building up huge reserves. So because it's at the expense of others in terms of the relative change in the relative exchange rate, so that's why it's not looked upon kindly. And then the US has this list of who are the currency manipulators, and India has been, put on that watch list again, as it was earlier as well.
And that the currency manipulation also risks the danger of inflation, isn't it?
Yeah, so when you try to prevent appreciation and you buy up dollars, then basically for every dollar you buy today, you put in 72 plus odd rupees into back into the Indian economy. And when this is if when the RBI buys up dollars, so the RBI's monetary base expands. Now, if it does not sterilize this operation, then basically it has expanded the monetary base and therefore it is inflationary.
But the bigger problem you talk about today in your column, Ela, is about how this whole, RBI's intervention also leads to people trying to play with the system and trying to hedge in the currency markets. And
Not
that is the sorry
not
uh, in the markets. But you also talked about why the RBI should not hoard. I mean, that is the overall argument of your piece today. That this is actually a risky kind of a policy. Can you elaborate on that, Ela?
Yeah. So, I mean, think about firms who think that the RBI is going to keep the rate within a certain range. Now, the logic of hoarding, that is, of holding reserves, that is given, is that if RBI has reserves, then they will not the rupee will not crash, right? If there is too big a pressure on the rupee to weaken, the RBI will be able to sell off reserves and keep the rupee up. Now, what effect does this have on firms? Firms who, you know, are always looking for money to borrow and cheap money to borrow would normally think that, oh, I can borrow in dollars. And the dollar borrowing of firms has increased significantly. And they have the option of either hedging in the forex markets or of leaving their dollar borrowing unhedged. When RBI is holding large reserves, it is effectively giving out a signal that you will not see a sharp depreciation of the currency. We will step in and we will prevent a sharp depreciation. So, for a firm, if the rupee were to depreciate, it would have to pay back more in rupees, and or it has to pay the costs of hedging in forex markets. But if it is very sure that of it, or if it believes that the RBI is going to step in and prevent rupee depreciation, then it will leave its bets unhedged, its foreign borrowing unhedged. That is the moral hazard problem that gets created when a central bank is seen to intervene and is holding a large amount of reserves, because then everybody thinks, okay, I can go out and borrow in dollars and the rupee won't, and of course dollar borrowing is cheaper. Okay, usually even though dollar borrowing is cheaper, but because there is a risk of depreciation of the currency weakening, net you would think that it's as good as rupee borrowing. The two rates should equate. But in the situation where people believe that the RBI is going to intervene and prevent depreciation, more people get encouraged to borrow in dollars. So that's the moral hazard issue that a large holding of Forex reserves creates.
From moral hazard, we'll go to take a lot of questions that have already lined up for us from our viewers, Ila. But before that, I have an appeal to make to our viewers. India has $608 billion dollars of forex reserves. The RBI has $608 billion dollars of forex reserves. The print does not have those kind of reserves. We need our viewers and readers to pay for what they read and watch, because we also need to build some reserves, not in the billions of dollars, but let's aim slightly lower than that. But we need you to pay, because free journalism will not help institutions be built. We need to build a strong institution of the print, go on to produce good journalism and bring you Ilanomics every week, week after week. So if you have not taken a subscription, please do take a subscription, pay, go to the print website. The link will also be there at the in the notes of this show. So if you have not taken subscriptions, please do, my dear friends and viewers and readers. Ila, the first question is from Asohan Sri Karunya. It's a little, the phrasing, I hope we can understand what he's trying to ask. Asohan says, we can welcome forex reserves by the RBI if it benefits by getting the rupee appreciation against paying for crude oil purchased from the US. What are your views?
Sorry, can you explain the question, YP?
So basically, he's saying if we have such huge forex reserves, and this helps the rupee appreciate, which helps us exactly. That is exactly what I was afraid of.
No. So let's just go back to basics again. When capital is flowing in, people are selling dollars and buying rupees. Capital flow is a cross-border transaction, right? So of capital, so money comes into India. So any money that comes in is a dollar, and people are selling that dollar and buying rupees. So what happens is the demand for rupee is going up, and the rupee appreciates because of the capital flow. Now, if the RBI does not want the rupee to appreciate, then it goes in and it buys the dollar, right?
Yeah.
Otherwise, if it was in the market, allowing just the market to function, depending on the price of the rupee depended only on demand and supply in the market, then the rupee would have appreciated. So in this case, actually, when capital flows in, hoarding takes place hoarding of or purchase of foreign exchange takes place by the central bank to prevent rupee appreciation. So I think that needs to be clarified to the reader, to the viewer.
Yeah. The next question is from Shikhar Thanwar. It says, "Hi, Professor Ila. Uh, it's slightly unrelated. Do you think the government should take the same approach it did for fast tracking reforms, like it did for states to access borrowing 0.25% of SGDP for every reform initiated?" This is what the Prime Minister was talking of earlier this week.
I'll have to think about it. That you link up one thing to the other, and it has implications, and so we have to think about it and look at the wider implications.
Current Saxena, should we open the forex trading market as well now?
Well, we've had a so-called open forex trading market since 1991. That there, of course, the big participants in the market are banks, for institutional investors, or even, as a tourist, effectively, that is a market. You go, you purchase dollars when you go out, or when a foreign tourist comes in, the foreign tourist purchase. So, whether you buy them from a let's say a Thomas Cook, or SBI, or Amex, whether you buy them from somebody who deals, authorized dealers.
Mhm.
So these are authorized dealers who are authorized to deal in forex market. So that market is open in the sense that there are many participants. Now, there are limits to how much you can hedge, how much forward trading you can do, whether you have so much export, you have so much currency exposure, and that some limits are put in on that. But for the current account, actually, the forex market is completely open. For the capital account, that means trades that take place for the purpose of sale or purchase of assets, those cross-border transactions, there are limits to it. So there's no full capital account convertibility.
Yeah.
That would be the other way of saying this.
Uh, Abhi Vijay Kumar asks, ma'am, should some portion of the forex reserves be channeled to a sovereign wealth fund?
No, I don't think that sovereign wealth funds are a good idea for India. Honestly, I mean, let alone the fact that this is not something that when if you're buying it for the purpose which you claim to be buying it for, that is, you want forex reserves because they are liquid. What happens when you have divert them to a sovereign wealth fund? So let me first say what my problems with it are, and then I'll come to what it effectively means. My problems with it are in terms of the management of the fund. And the last thing you want is another bureaucratic structure created that could try to choose which industries, which companies to invest in. I mean, I think India has enough problems, and we don't have institutional mechanisms. We don't have ways of recruitment and hiring of bureaucrats in a manner in which we hire the best in these markets. That's one issue. But apart from that, you claim to be buying these funds, buying dollars mainly to have liquid assets. So 15 months of import cover, or how much of cover you have for your short term debt. That is why usually they're invested in US treasuries, or at least either US treasuries or AAA rated bonds, but very very almost like sovereign debt of countries which have a very low probability of default. So these are liquid assets. Now, the moment you think about sovereign wealth fund, you are going to try and maximize returns with them. So you could be going and buying, say, an oil field in Africa or in the Middle East, which might make a lot of sense in terms of returns, but then you lose out on liquidity. And the very purpose of holding dollar reserves, like by Pina conversation which we started with, India had only 3 weeks worth of import cover,
Yeah.
and now we have many months worth of import cover. But actually, if I may point out, Michael Patra of the RBI has argued this week that, oh, even this 15 months may not be adequate,
Yeah.
because there are countries which have more import cover.
That's right.
So the last thing you want to do is to put this money into illiquid assets,
Mhm.
because the whole point is to hold liquid assets. So those are my comments on SWF.
You talk about taper tantrum and what happened when the taper tantrum episode occurred about, I think, 8 years back, 2013, in the aftermath of the global financial crisis. Pritish Prabhu talks about taper tantrum and says, what are the risks of a taper tantrum leading to a sharp depreciation of the rupee due to FII outflows? Uh, in such a situation, is it not good to have a high USD reserve, or is it good to have a high USD
So,
reserve?
so that's a very good question, because if in such episodes India had used reserves and used 300-400 billion dollars, and then been able to prevent rupee weakness, one would have thought, if that was possible, one would have thought, so it's a good idea to hold reserves because, now if the US starts raising rates, if inflation starts going up in the US, and the Fed has already indicated that it might start normalizing monetary policy. So you might have thought, yes, this is a good thing to do, to hold reserves. The problem is that any central bank that tries to use reserves, it actually, or faces what is called a speculative attack, then what happens is that everybody sees, it, the country has these many reserves, it can go down to so much, let me take money out before those reserves get depleted, whether it's foreign investors or whether it is Indians.
Mhm.
Indians who take money abroad, everyone wants to move out before the currency weakens. Then you can come back in when it has weakened and you can get more rupees. So for the Indians, it would be like, take it out now, come back after it weakens. And that perception that it will weaken once the RBI runs out of reserves, or any central bank runs out of reserves, that perception is what creates that speculative attack. So what we've seen is, so I mean, this is a old story. The speculative attack story is not a new one. Anytime a country tried to use reserves, so the UK had tried to use it, the Black Wednesday. UK had tried to use reserves when George Soros did a speculative attack on the pound, and he just kept on till the UK gave up and allowed, it used to be in the ERM and it had to
Mhm.
keep its currency, the pound, between plus and minus 3% of the Deutschmark.
Mhm.
So when it started, hitting the lower bound of this band, uh, money was going out of the UK, and the Bank of England tried to sell its reserves and keep it up until, of course, it realized that it was disappearing at a very, very fast rate, and more money was disappearing, and the pound had to depreciate. Similarly, this has happened in the Asian crisis as well, and it's happened to almost every country that has tried to defend its currency with the use of reserves, because reserves are obviously at some point, regardless of what that point is, they are going to go to zero. In the taper tantrum, when it happened in 2013, RBI also tried to use reserves to some extent, and they started disappearing very, very fast. There was one day in which RBI lost $7 billion of reserves. After that, it actually changed its policy. Instead of using more reserves, so it sold, I think, about 22 billion or so. But instead of selling more reserves, a total of 22 billion in the May to September episode, but then instead of selling more reserves, it started tightening markets. And, it pushed up the MSF rate, that is the upper bound for, and it reduced the repo window, and it really tightened liquidity. So that's the kind of thing that central banks do, because if you start using reserves, you invite a speculative attack. So the reserves really don't come in use, the supposed use, the objective of holding reserves to prevent a currency depreciation. It doesn't happen. It doesn't work like that.
In fact, Manas Agarwal also had a similar question. I think you have answered it, but I'll anyway read his question for you, Ila. He says, the Federal Reserve has pointed towards a rise in interest rates sooner than projected. That might lead to FPI flight out of the country. Aren't higher reserves justified for such a risk? I think, which is what we talked about.
Yeah. So, the Fed will raise rates, and you can watch what happens then. And if there is a pressure on emerging economies' currencies to depreciate, then uh, start looking at how they are responding. Are they using their reserves, or do they try to either tighten liquidity in the system, raise interest rates? Because if the interest differential has changed, then because of Fed raising rates, the interest differential can change also because of us, can go back to what it was because of us raising rates. So you'll notice that monetary policy gets used a lot. Those countries that have capital controls also try to use capital controls, but the level of reserves doesn't really change that much. So I don't see even a 10% change in reserves generally.
Mhm. Mhm. I think that's all the questions we have on the forex reserves, Ela, and we are also coming to the end of our show, 30 minutes. But there are so many other questions which are not related to the topic we are talking about. Uh, it's generally the sense of recovery now that the second wave is behind us. uh, there is lots of talk about how the second wave may not impact the economy as much as the first wave did, although a lot of the global rating agencies are revising their targets, gdp growth targets for the full year. And now there is a worry about the third wave and the delta plus variant and all of that. So, what are your thoughts on recovery? And we'll conclude our conversation after that.
So I think that we've learned some lessons. The biggest being that we can do local lockdowns and keep both the economy going, and we can also control the virus. But of course, the virus, it seems, is merrily mutating and is going to come back at us again and again and again. So we have to just keep vaccinating. We have to keep testing. We have to keep doing COVID appropriate measures, and with those we have hope of you know growing, because overall as a full economy as a whole has not shut down this time, and there have been pockets, of course, but I think that we will be able to recover. At least we are seeing positive growth. The economy is not contracting, it is growing, and we hope to come back to pre-pandemic levels if we don't see another devastating wave of COVID.
Thank you so much, Ela. Thanks to all our viewers who joined us today. Uh, Thank you. We will be back next week with another episode of Ilanomics. Stay tuned and watch out for our announcements on Twitter.